o'clock, and I'm sure people have got better things to do than listen to us talk about tax all night. So hi, everyone. If you don't know me, I'm Jo McCauley, but I think most people do know me. We're going to do our first masterclass, and tonight's masterclass is called Know Your Numbers. So we're going to talk about a few things. But before we start, I just wanted to introduce you to Martin. Martin is my CEO. A lot of people already know Martin. He's also moderating this. So he's running this meeting from the back end, which means if you've got questions or whatever, you can put them in the chat. We're going to make you be mute because we are recording this and we will be putting it up later on. But we may unmute you at the end if you have some questions. But while I'm going through the presentation, we're going to keep you on mute. But if you can't hear me or if there's a problem, please use the chat. You should be able to see a chat button either at the top or bottom of your screen where you can type some stuff in, and Martin will be moderating from there. So the other thing is we will be doing questions at the end, but you're more than welcome to put questions in along the way. So feel free to put them in, and then Martin can ask me the questions at the end. And lastly, I'm hoping everyone can see me. So if you can't see me, just put a little thing in. And if you can't see the presentation, please let Martin know. And yeah, let's have a bit of fun, go through some stuff, and hopefully you can learn something. Okay, so what are we talking about? Before we start, I just have a thought for the session. So it's always nice to start with a bit of a quote or a thought. And the thought is, a genius without a roadmap will get lost in any country, but an average person with a roadmap will find their way to any destination. And that's by Brian Tracy, whoever that is. But I think it's a really good quote when we're talking about accounting and tax, and we're talking about reading balance sheets and profit and losses and things like that. Because to me, they're the roadmap that you need to be able to read. And realistically, if I'm in a car and I don't know how to read a map, I'm not going to get there either. So tonight is about teaching you a couple of things about how to understand some of the basics of accounting, which we're going to talk about. Go through a bit of an example of a company so you can sort of see what I'm talking about and hopefully follow along at home. And then we're going to talk about a few other things. So let's go on to the agenda. So the agenda is, first of all, why you need to know your numbers. Secondly, overview of the reports. Then we're going to talk about the difference between profit and cash, which is a really important thing to understand, whether you're a business owner or even if you're not a business owner, but you just need to understand those sorts of things. There's a very big difference between profit and cash, which causes business owners lots of problems if they don't really understand that and don't manage that cash flow well. And then we're going to talk a little bit about what's going on at the ATO. Going forward with these sessions, if there is something happening at the ATO, I'd like to use this as a good chance to give you a bit of an update, just so that you're aware of some of the topics that are a bit hot at the moment and what they're about. We're going to talk a little bit about Xero, which is my favourite program and the program we prefer to use. And I just want to give you a few tips. I'm not going to spend too much time talking about Xero, but it's a good opportunity to show you just a couple of new things that have come out with Xero that you might be able to use if you're a Xero user. And then we'll finish off with a little bit about Jigsaw and our associated businesses and what we have to offer. And then finally, we finish off with questions. Okay. Sorry, I've got a bit of a cough already and we've only just started. Okay. So why do you need to know your numbers? And look, we see so many different business owners come through, and some people are really, really into their numbers. They spend a lot of time looking at them. They review them constantly. They understand those numbers. And then we have other businesses that don't really look at it. They come at the end of the year, they bring us a spreadsheet or they bring us a bunch of receipts and then wonder why they don't really know where their business is going, or they're unsure why they have so much tax to pay. But to me, the numbers tell a story about your business. I read these reports like I'm reading a book. I can pick up a report and I can pick up straight away where you might be having good things happening or bad things happening and what might be the problem there. So to me, they tell a story. And what we want to teach you as a business owner is how to read some of those stories yourself and start to think about what those numbers mean. They also, as I said, they tell a story. They also can tell us some of the symptoms versus the root causes of what might be causing you some issues. They can be early warning signs of something maybe not going so well, or there might be something that's going to be coming up in the future. They also can provide us with ideas of where our strengths and weaknesses are, and we can maybe then focus on those a little more. And they also, of course, support us in making better decisions. And this is something I spend a lot of time talking with my clients about. They'll come in and say, I need to buy a piece of equipment because there's a tax deduction available for that piece of equipment. And I always say to them, we never make a decision based on a tax deduction. We make a decision based on whether we need that piece of equipment or whether that is worth it for our business. Is it going to provide us with more income? Is it going to provide us with more profit? And if that's the answer, then we work out if it's a good decision to make. We don't make it because we're getting a tax deduction for it. And then, of course, knowledge is power. And the more you know about your business and how it's performing, the better you will be at running your business. Or if you're not working as an owner of a business, you may be working in a business and you may need to understand the numbers for your boss. It all applies. So all of this stuff is universal, whether you're a small business owner, whether you're working for someone and you're trying to run a budget or something like that. These are all very good things to know because financial literacy is something that so many people don't really understand, and it makes a huge difference. Okay, so what reports are we going to be talking about today? We're going to sort of go into a bit more of a deeper dive into the reports. Most of us know of the profit and loss and the balance sheet, and we're certainly going to talk about those. But I'm also going to talk about a couple of other parts of those reports, particularly the trading account. We're going to talk about the change in equity because equity is something that a lot of people don't quite understand. We're going to talk about the depreciation schedules, which again is a part of your financial statements that not everyone understands. And then that shareholder current account, which is something that we don't always have in your accounts. We have it usually as a particular line item, but it's definitely something worth talking about. When we do this, we're going to go through like a pretend company. So we've set up some figures for a pretend company, and we're going to talk through some of their figures and just sort of have a bit of a look at how we as accountants would look at the figures and what they mean. So let's start with the trading account. Now, not everyone has a trading account. So if you're saying, oh my God, I've never heard of a trading account, what are you talking about? It may not be relevant to your business. Usually trading accounts are for people who sell something that they have to buy in the first instance. So if you're running a service business where you're providing, like you're consulting to someone and you're selling yourself as a service provider or your staff as a service provider, you probably won't have a trading account. But if you're selling selling a good or selling something where you've actually got to buy stuff and then on sell that, you probably will have a trading account. So what a trading account does is it tracks the sales, it tracks the variable costs. So they're the things that are going to change depending on how much you sell to then tell us what our gross profit is. And some of you may have heard of the word gross profit before and not really understood what it means. Gross profit is really the difference between what you sell and what you're selling it for. So it's the margin on what you sell. So if you go into a shop tomorrow and you want to buy a t-shirt, you might pay $30 for the t-shirt and the shop has possibly bought it for $20. So the gross margin that the shop is making is that $10 difference. So that's what we're talking about when we're talking about gross margins. So we need to keep track of this because we want to see if we're actually improving on our gross margin or if we're actually reducing our gross margin. And if we are, that's something that's going to indicate our business is maybe getting into a little bit of trouble or something's not working quite as well. So let's have a look at a trading account for our little company that we've got here. So we've got a little food company. Let's call it food company. And food company obviously sells food. They have stuff that they buy, they've got the food, they've got to buy it in the first instance. And then they also have some costs involved with selling that. So you'll have a look here. We've basically got this up the top. We've got sales, we've got our stock, And then we have those direct costs, which are things like the wages of the people who are actually selling the food. Not all wages always are direct costs. Sometimes they're not considered direct costs. We also have delivery costs, and we have things like packaging and some of the other bits and pieces that are completely impacted by how much we sell. If we didn't sell anything, we wouldn't have any of those costs, if that makes sense. So let's just work through this slide. So we can see that the business has sold just over $1 million worth of stuff for the period. Also, at the same time, it's had $318,000 worth of costs of goods sold, so purchases. We can see they've got opening stock, they've got the purchases, and they've got the closing stock. So we're actually looking at how much of the sales that have been made for that period, how much of the stock actually cost for that. Because they could have gone and bought a whole lot of stock at the start of the year and not sold it yet. So we're really looking at the difference between opening stock plus purchases, less closing stock, which gives us our cost of sales. So based on those figures, we have a gross surplus from trading of just under $700,000. We then have the direct costs, which are $450,000 around that. So as I said, they're the other costs involved with selling. And this gives us a gross surplus of $248,000, so around $250,000, and a gross profit percentage of 24%. Now, based on your industry, you should have a pretty good idea of what a gross profit margin should be on your cost of sales. And if you're not sure, you can have a look at the ATO, and they do have benchmarks of what the general cost of gross profit would be for your industry, assuming your industry is one that has a lot of participants in it. And you can kind of keep track of your own gross profit and see if you look like you're in the same sort of level as the people who you're competing against. All right, now what we're going to do is just going to, let's say we're going to have a little bit of a discussion because we've come to our accountant and they've gone, look, 24% profit, gross profit, isn't that great? Let's see if we can make some ideas up on how we can get some more sales. So we're going to increase our sales by 10%. There could be a various amount of things that increase that. It could be that we're just going to put the price up by 10%. That might not necessarily increase our sales by 10%. It could be that we're going to do some sort of marketing program, or we're going to do something to increase our sales. At the same time, we're going to have a look at our costs of goods sold, and maybe we're going to reduce the amount of wastage that we have. We might be able to negotiate our prices on what we're buying. So we're going to reduce those by 5% as well. And then we're going to have a look at what the difference that could make just by that one little change. So for that one little change, an increase of 10% in the sales and a decrease of 5% in the cost of goods sold and a decrease of 5% in our direct costs as well, we're coming up with a gross profit of $389,000, which is quite a lot more than what we had before. We're actually making $140,000 more on selling in that period, and we have a gross profit margin of 35%. So again, having a think about that. So that's the fundamentals. I know not everyone has a trading account, so we're going to go on to our next bit, which is the profit and loss statement, which is something that probably everyone who's seen if they've got their own set of accounts. So the profit and loss statement, it tracks the overall performance of the business for a period of time, and we try to match our income and expenses for that period of time. So profit and loss is for a period of time. So we can look at it for maybe a full year. We might want to look at it for a quarter. We might want to look at it for a month. We might even want to look at it for a week, but it's always for a period of time. It doesn't continue on forever. The biggest amount of period will be a year. And at the end of the year, we kind of start again. The year is usually a financial year. Pretty much that's how we look at it. So let's have a look at our profit and loss statement. So what we're doing is we're bringing in our, at the top, you'll see the gross surplus of $248,000. That was from the previous slide. So that's where we've sold our sales of just over $1 million, and we've had our cost of goods sold against that. And then what we have after that is we have a whole bunch of other expenses, which we tend to call overhead expenses. So these things may not be, they might be fixed, they might be a bit variable, but they're not necessarily directly related to what you're selling. So things like accounting fees, there might be interest on your loan. You're going to have interest on the loan regardless of whether you've sold anything. You're going to have things like staff training, telephone expenses, all that sort of stuff. So other expenses not necessarily directly related to that thing you're selling. So based on this, we've actually brought in the figures and we've found out that this business is not doing so great. It's actually losing $113,000 a year, which is probably very concerning because if you're losing $113,000 a year, you're probably not going to be sustainable for very long. So what we're going to do is we're going to take into account the adjustments we made before with regard to the trading income that we talked about, where we got our better profit margin. And we're also going to look at some of our other expenses and see if we can reduce them a little bit. So we've talked to an accountant. We've decided that we could potentially change some, like our insurance down a little bit. We might be able to reduce our rent somehow. There might be some way we can sublease, whatever. Having a look at the figures, understanding what they mean and where can we make some savings. And so based on this 5% savings on those two things and the changes in that first bit, we've gone from losing 113,000 to making 138,000, which is quite a nice thing. We've also, in that part of that, we've put into it that maybe some expenses have increased. So for example, you might get some advisory work to help you work on these figures. So you might have spent a bit more with your accountant, but at the end of the day, we've made more money, which is a good thing. Okay, so that's profit and loss. That's the one that most people spend a lot of time looking at because it sort of makes sense. It's income less expenses. That's whether we're making money or not. The next part to the equation is the balance sheet. And the balance sheet essentially matches up your profit and loss and what else is happening in the business. And the balance sheet is as at a point in time. So the profit and loss might run for a year, so from the 1st of July to the 30th of June, but the balance sheet is as at the end of that period to look at it all together. So we look at our balance sheet on the 30th of June, or you can look at it at any point in time. I look at mine every day. Where am I sitting at today? And that will tell me all the other parts going to it. So it is your assets and liabilities. So this is where we start to hear those words assets and liabilities as opposed to income and expenses. Okay, so let's have a look at our balance sheet. Usually we start off with a balance sheet. We start off with our assets and we break our assets and our liabilities up into two different components. One of them is called current and one of them is called non-current. So current means that we would expect it to be converted to cash or it already is cash within a year. So within our current assets, we usually have things like cash at bank. Obviously that is cash already. And we have things like receivables, so trade receivables. So if you've sent an invoice out to a client, you would hope that they've paid that within a year. So that's considered current. The other major component of our current assets is inventory. So if we've got stock on hand, it would be our intention that that stock is sold within a year. If you've got so much stock that it's carrying over for more than a year, you possibly have too much stock, and that could be creating cash flow issues. So our little balance sheet here has a current asset of 138,000. We also have current liabilities. So current liabilities are things that we would expect to pay within a year. So this could include things like a credit card. Usually you would expect that your credit card is paid regularly, not over 20 years. It will include things like accounts payable, so bills you owe to your suppliers. It might include some employee entitlements such as PAYG withholding or superannuation that you need to pay. It might also include some of your short-term loans that would be expected to be paid within a year and things for the ATO like GST. So looking at those two though, we've got $162,000 worth of current liabilities and $138,000 worth of cash coming in current assets. That would indicate to me as an accountant, we've got a bit of a problem here. we don't have enough money coming in the short term to pay what we have to pay in the short term. That starts to make our situation a little bit bad. We then look at our other assets, like our non-current assets. So our non-current assets are going to be things like property, plant, and equipment. So when we go and buy a piece of machinery, that usually sits in the balance sheet. We don't write it off straight away. We depreciate it over a period of time. It might also include something like goodwill, which is what we bought the business for. So if we went out and bought a business for $200,000, that would sit in the balance sheet as a purchase price of the business. And there can be other things like we've got in here branding. There could be some sort of trademark fee or something like that that are considered non-current assets. On the other side, our non-current liabilities tend to be business loans. So if you've gone and got a business loan, you might have a hire purchase for a chattel mortgage or an equipment loan for a piece of equipment like a car or something like that. They're going to be considered non-current liabilities. The difference between our total assets and our total liabilities is called our net assets. And our net assets should always equal our equity, which is up the top here. And that's why it's called a balance sheet, because they equal each other. Looking at this business, it has net assets of minus 309,000, which again is not a great situation. We would hope to see, like, that doesn't look like it's a business that's going to be sustainable. In effect, you'd probably consider this business is trading insolvent and probably needs to speak to someone pretty urgently. Okay. So what they might do is look at the other thing that we find with balance sheets is we start to look at some of the ratios that can tell us a story. And one of the important ratios that we look at is something called debtor days. So debtor days is a ratio of looking at the total debtors. So how much money is owed to you as a business, and we divide it by the number of sales that you've made for the year, and we times it by 365, which is the number of days in the year. So based on this little business, it's got debtors currently of 72,000. We've had $1,017,000 worth of sales. It gives us a debtors day of 26 days. That means on average, it takes our clients 26 days to pay our bills. Now, think about it. When you do your invoice, how many days are you giving your client to pay you? And are they paying in that period of time? Because wouldn't it be better for that cash to be in your bank account so you can use it than in your client's bank account, in your client's bank account? And we need to look at how can we improve those debtor days. So if we were to improve those debtor days by 5 days, we would end up with an extra, based on these ratios, we'd end up with an extra $13,944 in our bank account. So that would be better in our accounts. And often we find people don't like chasing debtors. People don't like that confrontation of saying, why haven't you paid me that money? But it's so important that you get that money in and you keep those debtor days under control. So have a look at your balance sheet at the moment. Have a look at what your debtor days are, do the calculation, but more importantly, look at it over a period of time and start to see whether it's getting better. The other thing that ties up a lot of cash is inventory. And again, we can do a ratio on our inventory. So inventory is the stock that we're holding if we hold stock. Not everyone holds stock. So if you're a consultant, you're probably not going to have any inventory. But if you are someone who is a shop, or you've got stock that you're selling on to your clients, you will have inventory. Inventory, stock on hand, they're all sort of the same terminology. So to do that calculation for that ratio, we're going to look at how much stock you have on hand and what is your cost of sales. So our cost of sales, remember we found that over on that very first thing we did with that trading account. So our cost of sale, our inventory is 64,000. Our cost of sales is 318,000. On average, using that ratio, it's taking 74 days for us to sell the inventory. That's 74 days that we're keeping that inventory in a warehouse. We've paid for the stock. We haven't got any money for it. It's tying up our cash flow. Again, if we had a little bit of a play with that and found a way to somehow reduce that, it would free up cash flow. So let's say we reduced it by 9 days. We brought it back from 74 to 65 days. We would actually have an extra $7,860 in our bank account, which might make things just that little bit easier. So these are the sorts of things we can talk about if you're a business owner and you really want to get to know your numbers. Right, let's go on to the statement of changes of equity. And what equity is it's the bit that you keep in the business. So we talked about our profit and loss being on an annual basis. At the end of each year, we roll our profit and loss over again. So on the 1st of July, we start with a clean slate. We have 0 sales, we have 0 costs, and we start all over again. What we are doing, though, is we're taking the profit and loss from the year before and the year before that and the year before that, and that's what we're calling equity. So it's the bit that's being left in the business. But then stuff does come out of that. So it doesn't just stay there, because often people go, why is my profit not equaling what's in the bank account? It's because sometimes we take money out as well. So let's have a look at a statement of equity. So in this business in 2019, we had a total equity of 191,000 minus 191,560, which means we've made lots of losses in this business. We've gone in, and that then becomes the starting equity for the next year. And then for the next year, we've had $113,000 worth of losses, and now we have that $305,000 worth of carried forward lost equity in the business. This business is not trading solvently. If we were to flip that around and it was a business that was solvent and it was making money, and we made all those figures the other way around, we would carry forward retained earnings. So we call it retained earnings in our accounts usually. If you have a look at your accounts, you'll probably see retained earnings. What can reduce our retained earnings is if we're drawing a dividend. And the other thing that reduces our retained earnings, if we're a company, is that we might be paying income tax, and that sort of essentially reduces the amount of retained earnings we have as well. It's probably not something you spend a lot of time thinking about, but it is something that's very relevant to your business, because if you have negative retained earnings, your business is probably in a bit of difficulty. If you happen to be trading out of a trust, your retained earnings will probably be nothing, because we have to distribute the income. So just be aware, this is probably more looking at someone who might be a sole trader or a partner in a partnership or a company. If you're in a trust, you might look at your retained earnings and go, I have none. That's because you're trading under a slightly different structure. The other relevant part to any of this business stuff is the shareholder account, because we often find businesses are trading quite well. They might be making a little bit of money. They might be doing okay, but they've been drawing money out of the business for their own benefit, and they're using the money that is in their business for their own living, which you should be able to do. And depending on the situation, you can, but you need to be mindful that if you're drawing too much out, it's going to put pressure on your business, and it might mean it's really difficult for your business to continue. So we don't necessarily show it like this, but as this is going, although sometimes we do, but just these is probably to remind you that if it is a business and you're taking money out of a business or putting money into it, we do need to keep track of that. It is a separate part of the accounts. So let's have a look at a shareholder account. And this is for a typical sole trader. If it's a company, we might have it in a slightly different format, and we might just call it a shareholder loan. But looking at this, we can call it an owner's drawings, whatever it is. So let's say when this Mr. J. Doe opened the business, he put some money into the account to get it open, and a lot of people do that. And then they might draw some of that money out, and then they might have to put some more money back in, or they might pay for something out of the business that they shouldn't really be paying out of the business. So we might call it a drawing as well. So in this instance, at the beginning of 2020, Mr. Doe had a balance of $29,000 that he'd contributed to his business to keep it running. He then had to put a bit more money into his business. So he had to actually put in another $2,000 to keep it running, because obviously it's not going that well, this business, and he needed to put a bit more money in. He's then actually drawn a little bit more money out. So he's gone in and said, okay, I might pay for my tax bill out of the company money, $8,000 worth. He might have some life insurance that he's paid out of the company, which is not tax deductible. So we've called it a drawing. So he's drawn some money out of it. And at the end of it, he's got a balance of $21,000 in there. That's how much money the company owes him or the business owes him based on what he's put into it. They might not be able to pay it because they probably don't have that money sitting there, but it's keeping track of what the business does owe to the owner of that business. And then the last part that I want to talk about with regard to financial accounts is the fixed asset register, which is something that does confuse a lot of people. And we do have many different regimes of how we keep track of our fixed assets. Unfortunately, or fortunately, the government keep changing it. So every time we have a budget, they give us a different way for us to treat fixed assets for tax purposes. And sometimes we treat the accounts in that way. Sometimes we do little different things. So you've all heard of the instant asset write-off. We've had lots of different variations to that. But what I'm going to show you tonight is how we would normally track fixed assets under a normal circumstance. This may differ a bit over the last few years with all the fixed asset write-offs that we've had. But the fixed asset records those fixed assets that you have. Things like vehicles, like plant and equipment, and we depreciate them over a period of time. So a typical fixed asset register looks a bit like this, and we're going to add the columns as we go along. So we'll go in and we'll have whatever you've purchased. So you might have purchased a car or a van, you've purchased some office equipment, and you've purchased some other plant and equipment, and we usually break them up into different components just as this does. The next column we have is the opening value of those assets. So every year we depreciate it. And even though we've paid $571,000 for all of those assets at some point in time, they're not really worth that at the moment. They're going to be worth a different amount. We're not going to go and get a valuation of every asset every year to see what they're worth. We're going to do depreciation every year, but we're going to start with an opening value, which is all the other years of depreciation we've done. What we then do is add items that we might have bought into this. So during the year, this guy's gone and bought a website and has decided he wants to depreciate his website. He's also gone and bought a security camera. So we've added some new assets to the register. And then he's also disposed of some things. So you can see that there's in the disposal column a couple of really little items that probably aren't worth anything anymore. Sometimes we go back in and we'll say, that computer, you bought that in 1995. I don't think you have that anymore. Let's get rid of it. Or he might have actually sold some of those assets. Given the amounts in here, he wouldn't have sold them. We've just probably decided to write them off because they're probably not there anymore. Then what we do is we work out what rate we're going to depreciate our assets at. And in Australia, we have effective life tables that the ATO give us, and typically we can use those rates to do our depreciation. We may also self-assess if we want to, but we should have some rationale behind that. And so there's a rate for everything. Now, this example I'm giving you is actually being produced for me from a company in New Zealand. So I didn't write all these figures up myself because I'm not that clever. In New Zealand, their depreciation rate for a car is 30%. In Australia, it's not. We have a different rate. It's actually 25%. But we also have this other thing called pooling, which gives us a whole different way of depreciation. So this just gives you an idea of what we're doing. Now, there's also two methods for depreciation. There's one called diminishing value and one called prime cost. Prime cost means that we're going to look at the value and we're going to depreciate it by the same amount every time for how many years it takes to depreciate. With diminishing value, we look at the opening value and we times it by that depreciation rate, and then we have a new closing value, which we're going to have now. So we work out the depreciation by timesing that, and then that gives us a new closing value. So if we have a look at the van at the start, it's got $7,846 worth of, that doesn't make any sense. That's a closing account depreciation, sorry. Let me go to the next one. Yeah, so it's got a it's got a value of 7,846. We would have times that by 30%, which gives us our depreciation of 2,000. We then take that off the opening value, which gives us a closing value of 5,492. Next year, we'll depreciate that 5,492 by 30%. So it never really depreciates totally. It gets very, very small, but it's never going to go away. If we're using prime cost, it will get to zero because we're going to do it by the same amount until we get to zero. I think it's always worth having a bit of a look at your depreciation schedule just to see what's in there, and often having a bit of a discussion about whether we need to write some of that stuff off. We've probably already written it off in tax, given the regimes we've had in Australia over the last few years, but it's probably good just to show what you really do have and what you don't have. So that is the fixed asset register, and that's pretty much the discussion on balance sheet, profit and loss, and those 5 main accounts, which are assets, liabilities, income, expenses, and equity. But one of the things that we find that business owners get really unsure about is the difference between profit and cash. And profit and cash can be the same, but they're usually different, and they can be very different things. And this is why people come to me at the end of the year and I say, here's how much profit you've made. And they go, where is it? I can't see it. I don't have that money sitting in my bank account. So this little saying, turnover is vanity, profit is sanity, and cash flow is reality, is quite true. We want to make sure that we have cash flow under control. And to understand that, we need to actually have a look at why some things impact our cash but might not impact our profit. So we're going to talk about a couple of different elements that will impact our cash but not impact our profit. So the first one is GST. So everyone says to me, I don't have any money to pay my GST. That's true, but it's not going to affect your profit. It's only going to affect your cash. GST, we're going to talk about in another masterclass. We'll have a masterclass on GST, but GST literally will not, you can pay as much GST as you need to. It's not going to affect your profit, and it's not going to affect your tax at the end of the year, but you will have to pay it. So you always need to be mindful of what GST you owe. The next one is loan repayments. And again, a lot of people, when they have loan repayments, think that that's going to affect their profit. It's not. It's going to affect your cash. What is going to affect your profit is the interest on the loan. So the interest on the loan will go to your profit and loss. It'll be an expense, and you're going to get a tax deduction for the interest on the loan. So sometimes people are going, well, I'm paying all this money out for these loans I have. I shouldn't have any profit. You probably do. You don't only get a deduction for that interest. The next one is asset purchases. We've just looked at the fixed asset register. If you go and buy an asset and you spend that money, that's not on your profit and loss, that's in your balance sheet, and it has an impact on your cash flow. If you have an asset sale, that is also going to impact your cash. So sometimes you might have you might decide you want to sell your car. That isn't necessarily, some of it might become part of your profit and loss, but most of it is actually going to be a reduction in the assets that you have in your balance sheet, but you will get cash in, so that could be a good thing. And then the last one I want to talk about is depreciation, which is when you do buy those assets, the depreciation is going to affect your profit and not necessarily your cash flow. So understanding that cash flow and profit are very different things can really help you to make sure that you're running your business well, and making sure you've got that money saved up for those things that you will have to pay for that may not necessarily be reflected on your profit and loss. Okay, so that's what I'm going to talk about with regard to these things. Now I'm going to move to the section where I'm going to give you a bit of an update on some of the things happening at the ATO. I'm not going to talk about it for too long, but it might be something that you want to know, because everyone has to deal with the ATO. So the hot topic that we've been talking about for the last couple of weeks is that we got an announcement by the ATO telling us that they're going to start sending letters out to particular people to change them from a quarterly business activity statement lodgement to a monthly business activity statement lodgement. And why they're doing that is because they're seeing that these people are either constantly running a bit late with their lodgements or never paying their BASs on time in full. Now, my understanding is that about 3,000 of those letters were sent out a couple of days ago, and some people might find that they've been put into a monthly lodgement cycle from the 1st of April, which is quite unusual. The tax office don't usually change cycles mid-range through the year, but they are looking at doing that. Now, if you are someone who does get that letter, I think it's probably a good chance for you to have a bit of a think. Do I need to be doing something different? Why can't I pay my BAS every time? Why am I a bit slow in lodging my BAS? Is there something I need to do? Take it as a bit of a kick up the butt that it's time for you to think about your business a little bit better, and have a talk to your tax agent, have a talk to us if we're your tax agent, and we can try and help you to get into this habit of paying your business activity statement on time. When you're paying a monthly business activity statement, it's probably easier to pay than a quarterly one because at the end of the quarter, there's a lot of money to pay. The next thing that is coming up, and I know I've been talking about it a fair bit, but you may or may not know about it, is that payday super is coming from the 1st of July 2026, which means on the day that you pay your staff, you should also be paying your super on the same day. We've been trying to ask our clients to start moving towards that so they get into that cycle of being able to pay on the day. It's going to have a huge cash flow impact for those people who are not used to doing that. So start to think about it. But in line with that, the other thing that's going to happen is the small business clearinghouse is going to close, which means if you aren't using a piece of software to pay your superannuation, you're going to have to find a way to do that. So if you're using the small business clearinghouse, which is you go onto the ATO and there's a way that you can pay your super on the ATO, talk to us. We're going to help you. We've got to find a way around this, but you've got to find a solution pretty soon because by the 1st of July 2026, that won't be available. I'm guessing it won't be available before then either, and we have to start finding solutions for those people. The other thing that's coming up is the fringe benefits tax year is just about to finish, which it doesn't align with our financial year. It aligns with the 31st of March. So we're just about at the end of that. It is really important if you are providing fringe benefits to your staff, which typically is a car, but it also can include things like entertainment benefits. It might also include other things like you might be providing interest-free loans to your staff. There's a whole bunch of things that come into the fringe benefits tax regime. It's really important that you lodge a return if you are in that. If you're a client of ours and we think you need to lodge an FBT return, we will be contacting you. Melissa from our team manages all of the FBT returns. She's a real expert at it. She knows how it works, and we'll try and make sure that we get things right for you. But it's not optional. If you need to lodge a fringe benefits tax return, we need to do it. Now, the ATO, what they've started doing lately is giving us these focus areas for small business, and each quarter they seem to come out with what they're focusing on, which is really good because it gives us a bit of information about what we might need to be looking at for you. So this quarter they've come out with their 4 areas of focus, and the areas of focus are as follows. The first one is business income is not personal income, and there's a lot of things that go with that. It's quite an in-depth topic, but they're very much looking at making sure that we're not claiming tax deductions for things that are personal and not business. I know a lot of clients like to be a little bit imaginative with how there's a connection between that expense and their income that they're making in their business. But the ATO are really starting to crack down on that. So if you think that thing that you're buying may be deductible, but possibly isn't, and probably in the pub test it wouldn't be, maybe just be a bit cautious with putting it into your business and talk to your tax agent and see what they think. The other thing is it might be partly deductible, but not fully. So again, have a talk to your tax agent. Let's make an estimate of what we think that should be and go from there. That's the first focus area. The second focus area is in regard to some of the small business concessions that we get, and they're just checking to make sure these 3 areas in particular not being abused. So the three areas are non-commercial business losses, small business capital gains tax concessions, and small business boost measures. Now, I'm not going to go into any of those. They're very complicated, but it would seem that people are not always abiding by the rules with these very complicated things. And so the tax office are looking into some of those to make sure that if you weren't meant to claim these concessions, that you have to pay the money back. The third area they're looking at is operating outside of the system. So there's two particular things they're looking at with regard to that. In one of them is GST registration for taxis, limousines, and rideshare services. So I don't know that anyone listening to this is an Uber driver, but if you are, you have to register for GST. There's no turnover on those people operating within that industry. Everyone else has a $75,000 turnover limit before they need to register for GST, but not if you're in that in those industries. You have to be registered. And the other big one is contractors omitting income. How do tax office know that a contractor is omitting income in their tax return? They get this thing every year called a TPAR, a taxable payment annual report, from those people that are paying you, and they're matching that data. There's an awful lot of matching data going on out there. And the last area they're focusing on is called building good habits, which is what we just talked about moving people from quarterly to monthly BASs. The other hot topic at the moment is data matching from rental properties. The ATO are now getting information from various sources about rental properties. So they're getting information from your real estate agent. They're getting information from your banks, your insurance providers. They're getting information from the rental bond boards. And they're also getting information if you're happening to do something like Airbnb or stays or anything like that. So there's an awful lot of information coming in, and they're really focusing on rental properties at the moment. They do estimate that about 93% of rental property claims in tax returns are wrong. So it's something we're really trying to make sure that we get it right for you as well if we're doing a tax return and you have a rental property. Okay. Now I'm going to talk about Xero, and I don't want to keep it a secret that we love Xero here. I know there's other providers out there, and if it works for you using a different provider, that's fine. We don't make you change to Xero, but we do have a lot of clients now using Xero. And of course, there is a cost to using software. But if you're not using software, it's time for you to start thinking about, do I need to be using it? Can I save a bit of time by actually using a software? And we're really trying to get everyone to look at what they're doing and seeing if there is a benefit. So maybe you might have to pay $50 or $60 or $70 a month to use this product, but is that going to save you a lot of time and a lot of effort? And also, you have to be compliant now with things like single touch payroll and superannuation. Now, I'm going to just stop sharing for a minute, and I'm going to share just give me a second. Share. All right. I'm going to share Xero. Can you all see that? Martin, can you just say if you can see that?
Yep, yeah, I can see.
Great. Thank you. Okay, so I'm not going to give you a whole demonstration of Xero, but I just want to show you a couple of relatively new features for those who are using Xero that might just be something you can take home and have a look at. This is the demo company, and if you do have Xero, you have access to the demo company. So everyone has access to the demo company, and you can have a bit of a play around in there, and you won't hurt any of your own data. But one of the features that I'm really liking at the moment, and now it's going to log me out. Sorry, just let me stop sharing for a second. Don't you love this? Okay, give me 1 second. It logs you out if you haven't used it. I will be back in a sec. Okay, I think we can try again. Martin, can you see that again now?
Yep.
Thank you. Okay. Right, so one new feature that we have, and one thing we were talking about with all of those reports and ratios and stuff like that, One thing that we're really trying to get our clients to do is get on board with making sure that not only they're sending out invoices, but they're also keeping track of the bills that they have to pay. And this is something that not everyone does, but if you can start to get into the habit, and I'm working on it for myself as well, in trying to make sure I'm keeping track, I get those emails going, this is what I have to pay. And it's so easy to add it to zero now, and it will remind me that I have to pay it. But it also means that if I'm looking at my profit and loss report on my balance sheet, I'm actually getting a true picture. Because if I'm looking at a profit and loss report and I don't know what I have to pay in a week's time because I haven't put it into my zero, it could be telling me a completely different picture. So Xero have been making it really easy for us to add bills for quite some time. Just if you are someone who's using Xero, how you do it is you can go up here. There's quite a few different ways. You can go up to the plus sign and you can add a bill, or you can come up here and go to bills to pay. And it will give you a list of stuff, and you can add a new bill here. Now, there is a couple of different ways to do it, but this is a new feature that I just want to show you what you can do. And you can go here and do an upload bill. And this means what you can do is you can select a file and you can bring it into Xero and it will read it. So I'm going to select a file that I prepared earlier. Let's hope I can bring this in. And it's an Officeworks invoice. So I'm not really giving away too many secrets there. So I just pick it out of my files, I upload it, and I close. And it's going to take me, it takes a minute because it's got to read that. So I'm just going to try and refresh my screen. Go back to the drafts. I haven't got there yet. And now it's here in my drafts. Here's that Officeworks invoice that I've just added in. So now I'm going to just click on it. And it's telling me it already exists because I did try this before. But what it's going to do is it's going to have a picture of the invoice that I've just attached. It's going to say it's picked up that it's Officeworks. It's picked up the date. It's also picked up the due date. It's picked up the reference number. It's picked up the amount. It's picked up half the information we need to know. In here, I can put a description if I want. I don't have to. And in here, I can type in what the account is that I want to code it to. And I hit approve. How easy is that? I'm sure for those of you who are trying to keep track of their bills will find this is a really easy way to do it. So the other thing that the benefit to that is if you are then going in to look at your bills to pay, and you can see here what's awaiting payment, you'll see there's two here because I did one earlier, but you'll see that there's a little picture here, and I can just click on it and it will show me that picture. So we can keep track of all of our expenses at the same place, and we can go back and look at them whenever we want to at that invoice. It makes life so much easier. As an accountant, if we're looking at your invoices and seeing what you've actually coded, it can help us a lot too. So have a try at doing that if you're using Xero. The other thing I'd like you to do if you're using Xero is to have a look if you have access to this. Not everyone does, because it does depend on your level of subscription. But there are these analytics that you may have depending on your level of subscription. And there's two particular ones that I want you to have a look at. One of them is your short-term cash flow, and the other one is your business snapshot. Now, this is data that is a test data, but what it does is it does give you a bit of a snapshot of where Xero thinks your cash flow is going based on what you've put into it. It's only going to be as good as the information you tell it. So if you're not putting your payables in and you're not keeping your invoices up to date, it's not going to be right. But if it's there, it will give you a pretty good idea of what it thinks is happening. And then the other one is the business snapshot, which is going to look at different things. You can change what period you're looking at. It's going to give you a whole bunch of little metrics. We've talked about some of these things today. If you're a gross profit type person, you will have that there. It's going to tell you what your biggest expenses are. It's going to show you what your average days are to get paid. We talked about that one. So there's all sorts of things in there that it might be worth you just having a bit of a look at and seeing if there's anything you can find there that will be helpful. Yeah, so I'm just going to stop sharing and go back to my slides. Give me 1 second. And hopefully that's there. And then I'm just going to tell you a little bit about our other businesses for those of you who don't know everything that we do here at Jigsaw. So we have a couple of other businesses. So first one is Evaluate Your Business, which is a partnership that I have with Martin, who is on here and talking to you and telling me if I can see my screen or if you can see your screen, my screen. We at EYB, we do consulting. So this is particularly around consulting. We can do coaching sessions, we can do business planning sessions, we can do all sorts of consulting stuff for you. So if there's something that you're having problems with, a lot of this stuff about running through the balance sheet and seeing where we can help you, that's consulting. That's not necessarily a tax thing. We also have Opal Plan Management, which is a NDIS plan management business that's in conjunction with Deanne and Melissa from my team. We run that together. And if you happen to know of anyone who's an NDIS participant and needs plan management as this particular part of the NDIS, we can help you. Unfortunately, if you're in Goulburn, we won't help you because we have Jigsaw Plan Management, which is run by Kay Rudd, who works out of this office, so we won't take clients from Goulburn. But if you're anywhere else in Australia, we're more than happy to help you with your NDIS plan management. So you can talk to us about that and we'll tell you how it works. And then the other business we have is the Accidental Bookkeeper, which is twofold. It's a podcast. We run it every week. Jade, who is from my team, it's in conjunction with Jade and I, we run the Accidental Bookkeeper podcast. It usually drops on a Friday. I'm not doing one this Friday. I'm in a very busy period of my life right now. I'm about to move house tomorrow. So we're just having a week off, but have a listen. It's on all of the platforms, Spotify, Apple iTunes, wherever you get your podcasts. But we also can do a little bit of bookkeeping using through the Accidental Bookkeeper too. So if you do need bookkeeping help, please yell out and ask and we can help you and see if we can help you anyway. I just want to end off with a little offer because I was talking about our coaching, and I'm not asking anyone to buy anything, but if you are interested in coaching, we are offering 8 coaching sessions. So it doesn't have to be 8 weeks in a row. It might be once every 2 weeks or something like that. We normally charge that at $3,200 for 8 coaching sessions. We're giving a special offer where we'd have the first kickoff session with Martin and I, so we can talk about what you actually want coaching on and determine who the best person is to do that coaching. It might be a collaboration between the two of us. Martin is more involved in strategy and operational help. I'm probably more involved in the tax and accounting help and helping you from that angle. Yeah, so if you were interested in that, please let us know. We're going to send out an email and you can contact us through that later on. So we have got a reduced price. You can pay it over a period of time too, so you don't have to pay it up front. So that's a good thing if you are looking for some help in areas, not necessarily account. It could be that you're just struggling with your business and you're not sure where to go and you just want some help and you want someone to talk to. We do coaching ourselves. Martin and I are in a coaching accountability group. We find it invaluable to talk to other people and get other people's opinions. So you may want to do that too. And now I'm going to ask if there's any questions. Is there any questions, Martin?
There is no questions in the chat. I might just
good.
unmute everyone just to see if anybody's got any questions.
Has anyone got any questions? We're going to unmute you now.
Let me just go unmute.